Joining me now is Sean O'Hara. He is the president at Pacer ETF. Sean, welcome to the show.
Good morning. Thanks for having me.
Of course. So investors have reacted favorably to bank earnings so far. What do you think is driving the rebound, and is it sustainable?
Well, I think overall the environment for equities is pretty solid. We do have some of these things that pop up from time to time. There's still this ongoing battle between, us and China over trade and tariffs. But I think in the end that will ultimately get settled. I think if the market really thought that it was going to be long and protracted and negative at the end of the day, I think we wouldn't be where we are. I think we have a earnings season coming here, and so far things look good, particularly led by financials. And I'm expecting that the Fed will, come and cut again this month, and perhaps even once more before the end of the year. So overall, I think the backdrop looks pretty nice for equities.
All right. And between the latest developments across big banks and regional banks, should investors be approaching the sector more confidently or more selectively?
Well, I think they're two different animals there. I think on the big banks, I think, the earnings have been solid. The regional banks, I think, you should be potentially a little bit careful. There's a lot of this private credit exposure there, and we saw some of that pop up. So I would be, if I was going to be investing in financials, I'd be investing in large cap financials as opposed to small and mid cap financials. With one further word of caution, and that is that financials as a sector right now is trading at like 19 times plus earnings, which is a little bit higher historically, probably about 40 or 50% above what the historical PE is. So if they can continue to grow their earnings to keep up with that multiple, then I think they'll be fine. But given the choice of large banks versus small or medium-sized banks, I'd be leaning towards those.
All right. And gold is often seen as a safe place to put money during uncertain times. But I understand that you prefer silver. And what makes silver more attractive to you right now?
Well, I do own silver personally. We don't have a commodities fund here at Pacer ETFs that we have in that game. But I think silver is sort of like poor man's gold, if you will. My premise for owning silver is that the gold-silver ratio is way out of whack. And I'm expecting hopefully I will close as an investor in silver. But I also think silver versus gold has more industrial uses. There's a technology play there where it's involved in a lot of these chips and software and hardware, that is a necessary component. So gold has been interesting this year. I think it's really more not a reaction to uncertainty, but fiscal policy across the globe. I think a lot of the central banks are buying gold. And I think individual investors and institutional investors are as well, as a way to protect, the value of their currency in the long run.
And I also understand that you're finding value in parts of the market that don't get that much attention. What areas, Sean, are you looking at?
Well, we use a screen called free cash flow margin, which is essentially just a converter, if you will. It's the free cash flow a company generates divided by its sales. And so it's just a measurement of how effectively a company is converting their sales into real profits. Sales growth is great if you can ultimately make money, but a lot of growth names have good sales growth but don't ultimately reach that end goal of actually providing, excess free cash flow. So we screen for free cash flow margin out of, for example, the Russell 1000. Right now, the Russell 1000 index is 392 stocks, and 7 of them take up 52% of the weight. That doesn't leave much weight or allocation to some of the other names in that broad index. And so by screening for free cash flow margin, we identify names like AppLovin, we give a bigger weight to Palantir and Palo Alto, Ubiquity, all names that have high free cash flow margin, but are very, very underrepresented in these broad indexes. And the performance of those stocks is as good or better than the Mag 7. So, for investors looking for, where to put money, if you've been riding this, this wave of these mega cap stocks leading the way, they can continue perhaps, but they're missing out on an opportunity by not looking at the smaller allocations of these broad indexes that are terrific companies that have high free cash flow margin, that are seeing their sales grow as fast, if not faster, than the big.
All right, and Sean, how are you advising clients right now?
Well, we don't actually advise clients here. What we do is work with financial advisors. So I'll give you a little peek at that. I mean, I think there's sort of two camps, if you will. There are those financial advisors we deal with that are leaning into the big names. And I think there are others who are trying to figure out like Wayne Gretzky used to say, it's not about where the puck is, but where it's going. And so positioning portfolios going forward versus looking in the rearview mirror. I think overall, the folks we talk to and their investors are, feeling pretty good. So there's not a lot of nervousness in the market. And so I just think, one of the things that we're seeing here at Pacer is, some folks are looking at small caps because they've underperformed, and that's a looking forward opportunity. We've seen a big change to our business with regard to international and global. With the run up that we've had here in the U.S., international and global has become a smaller part of overall portfolios. And, it has been tough over the last several years, but this year it's been a great place to be. And so we're starting to see people put portfolios together that are more in line with traditional asset allocation and try and get things back to more normal allocations. It's not all about 100% of the money in large cap units.
All right. Thank you, Sean O'Hara, president at Pacer ETFs.